All right. Well, thank you for joining us for what will be the last SEM University of the spring, I guess it is. We're not quite officially in summer, but we know everybody's kind of getting some seminar and webinar overkill. So we're going to take a break. We'll circle back in September and hopefully have some new topics for you. Before we get started, we are having some internet issues. It seems like internet overload at a couple of our offices here. So hopefully everybody's hearing this fine. But some housekeeping items. You can pause this if you have to take a call or whatever, and then you'll be able to catch up. You can also rewind. There's a question button that you can ask questions, and we will address those near the end. So let me go ahead and get started. And today's topic, I think, is very timely. It's something that SEM has always been about, which is using a behavioral approach to investing. And obviously, that approach becomes much more useful when you have a lot of uncertainty happening. And the first thing I want to look at is my rule number one with investing is not buy low and sell high, which is still something I would like to do. I think we all would like to do that, but it is the stock market will move in cycles of over and under reactions, and it's all caused by human behavior. And this is a chart we've used for quite some time. Courtney has spiced it up by using emojis there, but it is the psychological feelings that we go through at various stages of an investment cycle. And what's key about this is we all feel these emotions differently and at different times, but as a whole, you will see that the market will reflect these emotions overall as a consensus. And what we've seen happening in February and March was a panic. Everybody was looking at the economy shutting down and the virus numbers, and just sheer panic set in. But from what I saw from our indicators, we never got to the point of maximum opportunity because things quickly flipped back up, and people the whole way down were looking and asking, is this a buying opportunity? A true bear market, a true opportunity on the bottom of the cycle comes when pretty much everybody hates stocks. They're not asking, what can I buy at these levels? They're asking, how quickly can you get me out? And we did not see that happening. It's a good thing because it kept people in for the rebound, but it is not yet a true bear market in the sense of the emotional cycle. And I would argue that we are in what I would say the denial phase. For more of that, I put a link there. Courtney can put it out there in the announcements, and in the follow-up email, we'll put the link there. But we can talk more about why I believe we're in the denial stage if you go to that link after this webinar or sometime over the next few weeks and look at where we're at economically from a data perspective. But I will argue that we're in the denial phase. Now, one thing that's important to understand on a behavioral approach is it's very important to minimize losses because we all psychologically experience losses. The emotional impact to us is about twice what the impact is when we see gains. And that's been studied by psychologists. Actually, some of the people we're going to talk about here later have looked and done studies on this. But the other thing we find is interesting from an investing perspective is if you look at this chart, and you can kind of see where the losses here in yellow, 20% loss is about the point where you need to make 25% back. But you notice the gains you need to start making on the upside. For instance, if you lose half your money, you have to double it. You have to make 100% to get back to even there. And so going all the way down this chart, you can kind of see where the lines start to diverge and go exponential as you start to lose more and more money. And so what we've found, we've done thousands of risk surveys over our 29 years that we've been in business, and the median score that people say where they start to get uncomfortable is a loss in their portfolio of around 20%. That just happens to be the point where things go exponential. So most of our investors tend to want to be in a place where they don't lose more than 20%, which means if you lose 20, you only have to make 25% on the upside. If you lose 35, you have to make 54% on the upside. And that's why the S&P 500 has not even recovered its losses. It lost 35 by the middle of March from its high in February, and it needed to then make 54% on the upside, which means you have to take on more risk. Now, another thing to look at from a behavioral standpoint is we see a lot of people the last couple of years acting like this is a brand new approach. And I think the reason that they're doing that is in 2017, Richard Thaler won the Nobel Prize in Economics, and he is somebody who really explained things in terminology that most of us can understand, whether you have a finance background or not. He put it into layman's terms, and he was actually a black sheep, and we'll talk about that here in a minute in the economics field. But he's not the first to win a prize in the Nobel Prize in Economics from looking at behavioral finance. Robert Shiller won it in 2013 for his work on the irrational exuberance that people feel in the marketplace as they invest. But actually, Dr. Daniel Kahneman won it back in 2002. And what's interesting is he won it for economics, but he's actually a psychologist by training. But his work in studying decision making applied so closely to economics and finance that he won the Nobel Prize there. And so I know a lot of us are finally getting out of the stay-at-home orders. I put the books up there on the screen. If you are wanting to learn more about behavioral finance, I would recommend starting with Michael Lewis, as he's done with a lot of his books. He takes a very complicated subject and puts it in something that reads really well and tells the whole story, and really it talks about how behavioral finance came into being. Robert Thaler appears in the book, Robert Shiller appears in the book, and it takes Daniel Kahneman's work and makes it into something that's easy to understand. But those are all books that maybe for your summer reading list, if you're interested in learning more, I would definitely check them out. Now, let's dive in deeper into what Dr. Thaler was looking at from his work and what won him the Nobel Prize. And what happened was he had a list in his office because he was an economist, but he started saying, you know what, things aren't adding up. What I'm learning here and what I was taught doesn't match with what I'm seeing happening in real life. And he actually started calling the people that economists believe exist as Econs. He's also labeled them as robots because they expect the people in our economy to be 100% rational 100% of the time. And he started taking notes and making a list of times where people were not rational. And normally I would dive in and look at his list and some examples of that. But this list also applies to what we've been seeing with the COVID-19 information. And the first thing that we're seeing is surveys are showing that based on your political beliefs, that's how you're interpreting the data that's coming out of there. So we can have data and different groups are going to look at that data in different ways. And in fact, we just put out in one of our blogs that Cody wrote about a look at how where you're getting your information from determines how you think the coronavirus should be handled. And we're delving into things that now it's kind of masks versus no masks, economic shutdown versus no economic shutdown, stimulus versus no stimulus, and we're seeing a very large divide. And that's something that Dr. Thaler says is human nature. There's nothing wrong with it. It's just what makes us humans. But economists expect everybody to be rational and say, this is the very best solution regardless of my personal beliefs. And that's just not how things function. Now, the other thing that we see differing, economists believe that we will all think in terms of percentages. But what Dr. Thaler found was we think in terms of numbers. And this is a perfect example of what we saw was, depending on what the end data says, and we may not know until 3 or 4 years from now, we probably won't ever know for sure how many people were killed from COVID-19. But what we saw happening was people were using percentages, and a percentage of 1% didn't seem like a lot. And what we saw on March 31st was the president came out on national TV and started talking about we're going to see between 100,000 and 240,000 deaths from COVID-19 over the month of April. And even though that was still less than 1% of our population, people freaked out. When you took that percent and you put it into the number, we saw sheer panic. And I put the chart of the model that was being used by the advisors that the president had, and that caused the panic and really probably an overreaction, because we were being humans and we were looking at numbers and saying, well, I don't want to see 240,000 people dying. And we saw a panic, and all the shutdowns just really steamrolled our economy. The other thing we saw a lot of people doing was they were comparing it to flu, car accidents, things like that, and saying, well, what's the big deal? The big deal from a data perspective is how quickly we saw the deaths. And this was a chart going, looking at how quickly the deaths spiked up and just overwhelmed hospitals in certain parts of the country. And it's a way to say, well, this is why it's not the flu. It doesn't matter. You still saw people comparing it to the flu because they were looking at numbers. So it's our human nature to have this kind of a divide. But what I think is interesting is if you look at that line there for heart disease and cancer is, and I made this meme. I'm a big lover of The Office. If you've been following our blogs, I think everybody at SEM is a lover of the show The Office. And this is one, that I found was ironic is if you've ignored all these warnings over the years to eat right and exercise and take care of yourself, and now all of a sudden we see those same people wanting to wear a mask, and it just didn't add up, but that's how we are as humans. Humans need some sort of guardrails to make us do the right thing. If we always did the right thing, we would not need seatbelt laws. If we always did the right thing, we would not need drunk driving laws. If we always did the right thing, we would not need doctors, really, because we would, the issuance of heart disease and things like that are preventable would not be a concern. And, I use an example of, and this is something Dr. Thaler said, is if there's a bowl of M&Ms, or this case, we buy the bags of M&Ms at our office, if it is out, I will end up eating it till I stop. I have to actually count out, okay, I'm going to take 15 M&Ms, and then I'm going to put the bag in the kitchen and I'm not going to touch it. Because I will overeat, and I know it's bad for me, but I'm still going to do it. So humans need guardrails. Economists assume that we don't need these guardrails, which, by the way, and I heard a doctor from the Mayo Clinic describe this of, if you look at this chart again, heart disease, and you're more likely to die from heart disease than COVID-19. But also, if you look at the causes of heart disease, a BMI over 30, you have, a certain amount of sugary drinks every day, you aren't moving for 30 minutes a day. If you take care of those things, not only do you lower your chance of heart disease, but you also lower your chance of dying from COVID-19. So this is something, a perfect example of, this would not be an issue. We would not have issues of heart disease or deaths from COVID-19 if people would take care of themselves. And generally, it would have kept things less of a problem. But we're humans. We need those rails. We need somebody to tell us, hey, you need to make sure you're doing the right thing, and put those mechanisms in place to help us do that. So more on that. Cody wrote a good blog. Courtney can put that out in the chat, and we'll put it in the follow-up email. But he talks about some of the other biases that come into our minds as we were dealing with COVID-19. Now, let's move on to Dr. Kahneman's work. And I think this is fascinating because his original hypothesis was that we have two types of brains. It's divided into two systems. You have a fast brain and you have a slow brain. And Dr. Kahneman, as he set out to study our decision-making, theorized that your fast brain would do things that are easy to understand. 2 + 2. Hey, what's your address? What's your phone number? Things that are just ingrained in your brain. Your fast brain handles it. But then it's something else where you say, well, what's the square root of 129? Where you had to start processing it, your brain would take the time and do all the heavy lifting and get you the very right answer. But what he found, especially as you had more difficult decisions that weren't based necessarily on rules, was your slow brain was not a heavy weightlifter, but it was extremely lazy. And what he found was our brains would do what he called satisfice, and it would do a thing that he labeled heuristics. I call them mental shortcuts to get to a close enough answer so that it can go back to a relaxing state. Our brains do not like to work hard. And this was game-changing because he was then able to start studying different biases that impact the way our brains work. And we don't have time to go into all of those today. I put a link there of basically a research paper I wrote on behavioral biases. It's been one of our most popular posts. So on the blog, on the right-hand side of the screen, you'll see it on the most popular posts, Understanding Our Behavioral Biases. Definitely encourage you to check it out. There's also a video that I did with our clients that walk through the different biases, because it not only applies to your investment decision making, but all of your decision making in your life. Should I buy this house? Should I buy this car? What do I think of COVID-19? What do I think of the president's latest news items? It all plays a role into the way we make decisions, and I think it's definitely something that's worth your time to check out, to make your life better and to better understand how you make decisions. Now, what Dr. Kahneman did was he was able to begin classifying people into different groups because they tend to have different types of biases. And we're not going to have time today to go into those. Again, the blog has all of the different biases listed here, as well as some more on there. But what we found is you generally can be grouped into 4 different personality types. And if you're in that personality type, you tend to have certain biases. And what you'll see is conservative and aggressive investors tend to be more emotional. That's nothing wrong with that. We all have emotions at some point, but if you're that type of person, you're more prone to emotional biases. So there's things that we have to do as advisors and in our life in general to plan around those things. So that becomes critically important to understand, is what types of biases you have. We actually, from the blog, have a risk questionnaire. It's also available on our main website. Free of charge, 10 questions, gives you a starting point to identify what type of personality do you have, at least in terms of your investing life. And then from there, it has a little bit of some tips of how you might plan around your own biases that you have. Now, one thing, we're not going to talk a lot about the specific stock market today, but one thing that I've been showing for the last 12 years is what Dr. Kahneman labeled availability bias. My partner and our founder, Rick Gage, actually called it recency bias when I first joined him in the late 1990s. And what it basically says is your brains will remember things that happened more recently, and it will believe that those are always going to be the case. And the perfect example is the buy the dip mentality. Is every time the markets had a 10 to 15 or 20% drop over the last 12 years, it's had a nice snapback rally. And I put circles up there on the screen. And that works great. So every time the market falls, then you're programmed, because it happened most recently, to buy the dip. And that's what we saw happening in March. We saw people who just wanted to buy the dip because they knew it was a buying opportunity. But if you zoom out and go back to the 1990s, what we've seen is the market's moved in periods of cycles where you've had double-digit average annual returns followed by a very sharp correction. During those sharp corrections, guess what? Buy the dip did not work. People started hating stocks because now in their frame of mind, the most recent examples were that, stocks are always going to go down. I hate stocks. How quickly could you get me out? And this cycle goes on and on and on again. And if you look at that, we've had a period of 16% returns followed by a 50% drop. A 15% annualized return followed by a 53% drop. We've then now had a 14.4% annualized return history and data tells us that we're likely to have a very big drop. One thing that we look at is called the Buffett indicator. He's been a hero of mine from a value investing standpoint since before I joined SEM. I've read all of his shareholder letters, and most recently, you notice, and he said, I didn't buy anything because nothing was attractive. We don't have a lot of time to go into this chart today. I do talk about it in the economic update that we mentioned at the beginning. But one thing to keep in mind is the market is at a point where your long-term returns, if you were to buy today, are not likely to be very strong. And even in March at the lows, prices were not attractive for stocks. That's why Warren Buffett didn't buy, is we're still in that period where stocks are overvalued. And we'll have more of that in the blog as we work through the next few months as well. But the key concept to understand with our behavioral approach is it doesn't matter what your investments are doing if you don't have a solid foundation. And that solid foundation starts with your financial plan. And it doesn't have to be a sophisticated financial plan. It could be something as simple as a piece of paper that says, I'm going to invest X amount of dollars for 20 years, and that'll get me to this dollar amount, and then I'm going to retire. There you go. That's your plan. Or as you get closer to retirement, or you have more assets or more children or things you're trying to take care of, it needs to be more sophisticated. And just above that is a cash flow strategy. And the thing we asked any clients that we met with throughout February, March, and April was, has anything changed with your financial situation or your cash flow needs? If the answer was no, we said, let's take our personality test again. And we did over 100 personality tests from February to April. Only 2 shifted their personalities. And as we talked to those clients, it was because they were going through a severe change in their business. You know, they were in real estate and the other owned some restaurants. So their personality literally changed because of that, which happens. By the way, as we get older, we tend to get more conservative, which means we tend to get more emotional with our decisions. So that might justify a change to your investments. But the key to our behavioral approach is we need to know the financial plan, we need to then know the cash flow strategy, and then we need to work with your investment personality to find the right fit of investments. It can't just be, how much money do you want to make? Let's try to make as much money as possible. It has to have a foundation of a plan if it's going to work over the long run. The other thing that we really like to do that is critically important to our behavioral approach is to section things out in buckets. And we always start off with a long-term bucket because that's what Wall Street is programmed everybody to do. Is you're a long-term investor regardless of your age. You got to be in the market. So we say, okay, we want to be out there, but based on your financial plan, cash flow strategy, and personality, you can't handle losing half your money every 7 to 10 years, which is what happens with the stock market. And so then we adjust it down based on different needs, and we section it into buckets. We have your 15 to 25 year bucket, your 6 to 15 year, and then we have your shorter term buckets. And we have different investment models that we then layer into your portfolios so that you can have a much smoother ride and a better experience with your investments. The other key with SEM is we have 3 distinct investment styles. We have tactical, which is looking at the daily moves in the market. We have our dynamic models, which looks at the economy. And then we have our strategic models, which are more quarterly, long-term oriented buckets. We also have biblically responsible portfolios we call Cornerstone that can fit into all of those buckets. So if you're a Christian or a Christian advisor and you want this to be part of we can make a behavioral portfolio from all biblically responsible investments as well. So the way this looks is I want people to understand over the long term, I'm a big believer that the stock market is the best place to legally make money for you over that long-term period. But what we see is those cycles where people over-anticipate growth and then they under-anticipate growth. Over the long run, you're going to see stocks grow based on GDP, which is the economy, the dividend yield, and inflation. Now, I'm not going to go into it today. I actually do in the economic update that we'll have in the links. But where we're at today, we were here at the beginning of 2020. Now, unfortunately, we're still overvalued. We're still over-anticipating growth. Where we really want to be is where everybody hates stocks, and now the potential growth rate is extremely high for the stock market. We're not there yet, but I believe we will at some point. History and data tells us we will. What is key, and this is something we communicate with all of our clients and advisors throughout March and April, is we have a plan for all markets. Our economic model turned negative, not because of COVID in 2019. Obviously, nobody knew that was coming, but the economy was slowing down. So the economy that everybody is desperate to get back to is a very high growth economy that we weren't in. The growth was actually declining at the beginning of 2019 and continued to decline all throughout the year, from a 3% annual growth rate down to a 2% growth rate. So that's not really an optimistic thing. So our economic model actually sold some risky assets early, which helped us immensely. And then in late February, we saw a high yield trend reversal, which impacted a lot of our investment models. And then finally, in late March, we saw the longer term trend actually hit a bottom. And this is the key with our behavioral approaches. We're not guessing. We're saying this is what the data says. It may not always be right. And this is what's key is, even then when we got that sell signal, we said, okay, here's the general layout. If we have a V bottom, our high yield bond systems will confirm the uptrend. We'll start buying in. And then the stock uptrend will be confirmed with that same model that just said, oh, you better look out and put some defensive positions on. It'll confirm the uptrend. And then finally, the last thing that'll happen is the economic model will turn. And by the way, stay tuned to the blog. We'll have the link here at the end, because we will keep posting our economic model. It's not my opinion, Rick's opinion, Cody's opinion. It's what is the data saying is happening. So where we're at right now is we've seen the high yield bond uptrend confirmed. We're invested there. We've seen the stock uptrend confirmed very recently, and models are assuming a V bottom right now. But what's likely to happen based on my study of history and the data is we're probably in a prolonged recession. If that's the case, we're going to filter back down. We're going to move to defensive positions in our high yield bond positions. We're going to see that our AmeriGuard and Cornerstone model will start to take money off the table. But then here's the key. We'll eventually get to the bottom and we'll filter back up. There's no emotions, no guessing. The behavioral approach that we follow has a plan for all markets. It's been battle tested. We've been doing this since 1992. I joined SEM in 1998. And this is what we've followed since the beginning, is this behavioral approach has gone through all types of markets. Literally, people are guessing at the outcome. We've never been through this, so the only way to get through it is to use a data-driven process, such as we've outlined here today. So more information, we've covered a whole lot today. If you look at semwealth.com, I also put a link there. You can see the blogs right from there, as well as our risk questionnaire from there. And so with that, I'm going to look to see if we have any questions. I know we got a couple minutes here. Let's see. I got 3 in 1 minute. Let's see what we can do. Why is the stock market going up so much when there are so many people out of work and our economy has lost so much? 2 things. First off, the stock market is a forward-looking mechanism. It's looking at what are things going to look like in the future. But more importantly, if you think back to the cycles that we had, is all the determination of what people think the stock market should be worth are based on our current emotions. People feel good because the economy is reopening. They're over-anticipating how much economic growth is going to be, which is fine. We will ride that up, but the underlying economy eventually catches up to what's happening. So yes, the economy is terrible. Yes, the stock market doesn't reflect that, but in the end, stocks cannot be over-optimistic if the economy is not great. So stocks will eventually correct to what's happening with the economy. Question number 2, sort of related to COVID-19. God forbid it happens, but what happens if something bad happens to you, Jeff? Hopefully it doesn't, because I have a lot of family members that hopefully love me, and I have a lot of knowledge I want to give to them. But this is the key to a behavioral approach: is it's all system-based. Cody, Rick, Steve, they can all run the systems if I'm not here. Everything functions the same. In fact, when all this was breaking, I was traveling. The market was going crazy. Cody and Rick were taking care of things because the systems take place. If you don't mind, I'll go a little bit over. We're 1 minute over right now, but what, if anything, are you doing to prepare for the upcoming election? Honestly, it's nothing. Our behavioral approach is designed for whatever happens. It's likely to be volatile. We're seeing the emotions happening right now. I've always said, don't let your political beliefs influence your investment decisions. You go back to 2016, you go back to 2008, you go back to 2000. People had their opinions of what would happen if a certain person was president. It didn't happen. They were wrong. Doesn't always happen. There's a lot can happen. That's where our data-driven approach really is key. So I apologize for going over. I thank everybody for joining me for SEM University. Stay tuned for the replay. Also, check back. You'll be getting periodic emails from us for in the fall when we reboot the SEM Universities. If you have any ideas on what you'd like us to cover, use the contact button on SEM's website. And as we go through this, keep in mind, it is an emotional time. We all have our own biases. Let's try to think well. Let's try to think of the other side. Why might I be wrong? What am I missing here? Always challenge yourself. Understand your own biases, your own emotions, and just most of all, stay healthy, be kind, have some empathy towards others, try to do good. We're all Americans. We will get through this together, and I truly believe we'll be a better country when all of this is over. But it all starts with you personally doing your job and just making an impact in one person's life each week. So thank you.